Hey, Justin. I like the hat. It's a new one. Very stylistically distinct.
Thank you. Yes. Hey, I'm doing well, and I hope you're doing well. And I
Very
was in
good.
California recently and picked up a few new hats
Oh, shoot.
for me, but also now that I wear a different one all the time, I got to go deeper into the well.
You need a burn mechanism for the hats. There's an inexhaustible supply of hats. The supply is inflating, like the
You're
US
right.
dollar.
I know, but I'm not looking for the value of the hat to go up. I have invested in other things like watches and shoes, and
Okay. Those
those
are the
were
collectibles where you get the value appreciation, right?
hopefully,
Gotcha. Gotcha. Well,
or
let's
at
dig
least
in. We got
that's
a
what I
lot to
told my wife.
cover. Go ahead. Yeah.
Or at least that's what I told my wife when I bought them.
Right. Right. Exactly. You can pass them on to your kids. A nice heirloom as well, right? So
Yeah, the watch definitely, or watches. The shoes, we'll see. I
we'll
have
have to
big shoes
do
to fill, so to speak.
We'll have to do a segment on watches at some point in the collectibles, and we'll have to interview the founder and CEO of Watchbox for that, right?
Yes.
So 30 seconds on Watchbox. Uh, they have like the high-end retail footprint in New York City and other international markets, luxury markets. You go in and you can try on a watch and talk to a salesperson, and they make markets in these watches too. Right? They provide liquidity. You can call in,
Yeah.
like, get a bid, get an offer on a watch. And actually, that's how they started. I think they acquired a market maker and then built the retail brand around that market making, which I think is just fascinating.
Interesting. Interesting. I recently sold a watch. I should have called them. I didn't think about that.
So he's got like hedge fund mavens and PMs strolling in there, buying and
Yeah.
selling. I mean, it's really it's something else. But so a lot happening here.
A
Uh,
lot. A
a
lot
lot going
happening. You've
on.
got a burgeoning rap career.
Oh, the rap career ended, sadly.
You
Uh,
retired on top. It's not sad.
I went out. I was a one hit wonder. Gave him my best shot. Got 20,000 views. I didn't get any labels. I tried to decentralize and go around the gatekeepers with the 30% take rate fees, but it just wasn't for me. I'm going to sing in the shower though. So, you know, if,
There you
maybe I
go.
can create like a microphone in there and broadcast out if folks want to tune in. My pitch is better in the shower. I don't know what it is. Something about the physics of showers and singing
That's true.
that
It is good acoustically.
it does work acoustically, right?
Yeah, I can't. I couldn't carry a tune if I was paid to do so. So that wouldn't work for me.
Karaoke rock anthems is like the shortcut, I think, for for this. But
I like to do it. I just know how bad I sound.
oh, I agree. I wish I had the skill of singing. I mean, what the ability to make music with your voice. I mean, what a precious gift one could have, right?
Yeah, it is pretty incredible.
What should we get into today?
Oh, geez. Well, I would love to hear your take on the investment in the data center and AI space because it's just at this point every day, every week, there's a new, not just like article, but like groundbreaking set of kind of like enablement infrastructure being discussed.
Yeah, I agree. It's a topic I'm passionate about. Let's dig into it. So, two headlines came out in the last 2 days. We wrote about one this past week in Microsoft Stargate. I'll come back to that in a second. Stargate, of course, being a reference, I think, to that science fiction show that no one ever watched. Maybe watched one episode and forgot about it. It has like a wormhole to
Yeah.
another dimension. I think it's supposed to evoke this idea of the singularity being the center of what a black hole is. And black holes also have this concept of the event horizon around which information can escape. So I think that Project Stargate is actually a nod to their intention to build AGI. All right, I already stole the thunder from the topic I was going to kick to later. So let's start there. Okay, so
Stargate.
let's start there. Stargate, and then we'll get to Amazon. I'm going to share my screen here. This is an excerpt from the Lumina Ledger. We publish this every Sunday, cover a bunch of topics from AI to crypto to macro. So Microsoft announced this plan to spend as much as $100 billion on an AI supercomputer called Stargate. By the way, NVIDIA has already built capability to generate supercomputers at a mass production scale. Like, well, they'll be there within a few quarters, right? They're building exaflop capability. Exaflop is supercomputer capability. 3 exaflop supercomputers around the world, and now NVIDIA is going to start making that on demand. So this is a supercomputer that they're talking about, right? And it lines up with the timeline I said after the NVIDIA GTC conference. We'll have something like AGI in 4 to 5 years. This thing will be built in 5 years. And they're spending a bunch of money. That's the main takeaway. So who are they spending money on? They're spending money on semiconductor firms and data centers and all the info that goes into building out a data center. And all the
energy
that flows from the data center, right? Electrical, energy, utilities, nuclear, software stacks, hardware stacks. So that's one. We heard that this Sunday. And then today, here's another headline from Bloomberg. Amazon bets $150 billion on data centers required for AI boom. So we've got an arms race between Microsoft and Amazon. Now, Microsoft and Amazon are the 2 leading cloud providers globally. Okay.
That's right.
Google's like a distant third, rooting for Google, but they're not there. AWS owns like the startup market and also other corporate enterprise too, and government. Microsoft dominates in enterprise though. Okay. So these 2 are running forward. Google's actually not dropping as much CapEx, by the way. CapEx, of course, I know you know this, but for the audience, property, plant, and equipment, like heavy fixed cost investments. Like when you build a data center, talking a lot of money, you got to have it with the appropriate cooling and the right location with the right energy, because you're going to take enough energy for several towns. That's CapEx, and you're dropping tons of money on GPUs, right? So Google's, and it makes sense, Google's not spending as much as these 2 because these 2 want to hold on to their pole position. They're going to compete. So Amazon, $150 billion required for AI boom. Spending spree.
Where are they looking to put these? Have they discussed that?
All over, globally, in different, here's one: Mississippi, Virginia, Oregon, Saudi Arabia. This plays into our sovereign AI kind of sub-thesis. Malaysia.
Sure.
Amazon's planned outlay on server farm dwarfs the public commitments from Microsoft and Apple, Alphabet's Google. By the way, credit to Amazon. They went from 0 to first rapidly. All of the major AI LLM models are now available on AWS, from Mistral to Meta Llama 2. They're all there. And you can see their square footage here of the Amazon cloud computing empire.
It's amazing.
So they actually shrank CapEx last year, and they went full throttle very quickly. That's extraordinary leadership. They turned around on a dime. They saw an opportunity, went after. I'm not a big fan of Amazon stock, by the way. Don't take that as an endorsement. Amazon's 4 PE is more expensive than NVIDIA, which is where all this money is going to. And with that expensive PE, you're buying Whole Foods for like a 60 price to earnings ratio or something, right? Like, so,
my Whole Foods bill suggests that that's a good ROE though. It's so expensive to shop there. I digress.
Get like share rebates, rewards programs, or something like that.
Yeah.
In crypto they do that. They call that like airdrops, right?
Yeah, exactly. I would take some Amazon stock in exchange for my grocery bills.
Look, I like the Whole Foods. They've done a lot out there. I wish that Amazon could get into banking to compete with JP Morgan, which is going to report earnings in 2 weeks, a few weeks coming up soon. Right? Talk about like Amazon's got a branch. They've got groceries, they've got Whole Foods, they've got a UPS return delivery. All you need is a bank branch in there. Talk about competition, strengthening the banking system. Look at me starting on that one. So
Walmart tried that. There's a strong divide. You and I can discuss that on another time, but
that's right.
Point. Yeah, I was just pointing out that a lot of this is going to go into the US. I know it's going to be globally and there are places, but it's also interesting because we talk so much about society is so fearful of the displacement that AI will create in jobs, but it also is creating other opportunities and jobs, right? Like if you think about the sheer labor that will go into constructing and building the hardware and software and facilities that are required for the level of energy and compute that is going to be used in the future that these firms are contemplating, it is staggering.
I agree. This is not the time to get worried about job displacement. There'll be a lot of change, but the pie is expanding at an accelerated rate. At the beginning of the 20th century, 1900, half of Americans were farmers. And now 1% of Americans are farmers because we had new technology, fertilizer and plows and, the John Deeres of the world. So, but yeah, it's going to be a wild future. So to your point, truck drivers might be on the chopping block. Not quite yet, but we're having the first test drive of federal autonomous vehicle oversight. And I'm proud to say Tesla's playing a leading role in making this future come to reality. I'm kidding. Tesla's not involved in this whatsoever. Waymo's got driverless cars in SF. Tesla doesn't. What's Tesla? Tesla's down 5% today. No surprise to readers of the Lumina Ledger, by the way, I might add, right? We avoided that thing. I have a lot of respect for Elon. You and I have talked about Elon. He's an incredible human being in terms of what he's accomplished and advanced humanity as it relates to technology. So give me one quick second, Justin. I'll be right back. My son's knocking on the door here. This is live, real deal, live. Okay.
This is live. Yeah. Got little humans coming in. They want to know what the future's like. So I won't keep everybody who's here in silence. I'm fascinated. I have some friends who previously worked at Google's Moonshot location, and I saw Waymo's cars driving when I was on their facility, and I was blown away by their capabilities, but it still is taking such a leap to get to full automated driving. I was listening to a conversation about trucking and drivers and what predicted percentage would be fully automated in a decade. And, whatever this prognosticator's opinion was worth, who knows? But they still said that it was going to be in the kind of like 20 to 30%. They felt that truck drivers themselves may have a reduced role in the driving, but in the actual both oversight as well as kind of like the physical labor involved in the securing of payloads, like a flatbed that is securing construction equipment, in a truck that's moving cars, right? Like there's actual physical labor that is required that, we're far away from robots handling that kind of AI robots handling that kind of labor. They're just pure driving that may be displaced. So it's going to kind of be like a human and an AI working together for some extended period of time. You're on mute.
Sorry. Right. So it sounds like there's a repurposing of the profile of what truck drivers are. We won't call them truck drivers. We'll call them truck secure / power. We'll find a better title, but
operators.
Could be this decade finally, though. I remember like 12 years ago, we were talking about how early 2020s we were supposed to get driverless cars. And it looks like that promise is finally in sight 8 years from now, although it kind of feels like nuclear fusion. But we're getting closer. We're seeing real traction, real product market fit in SF on the consumer side. And then on the...
Am I a boomer since I don't want a driverless car?
Oh, dude, I can't wait. I will be the first to admit I'm a below average driver. I'm not a great driver.
I've driven with you. I was a little scared.
You know that. Oh.
Everybody think, well, you don't, but many people think they're an above average driver, which obviously if like law of averages, you're not.
I think,
but
correct. Exactly. Like you said, that's a good point to like Daniel Kahneman, who sadly passed away, Nobel laureate, author of Thinking Fast and Slow, along with Amos Tversky, another Nobel laureate, and the attribution fallacy, right? People overestimate their own abilities. I think if you want to be a good investor, you have to be humble enough to know what you suck at. I'm not a good driver. I'm not good at cooking, except for like one or two things. A lot of things I'm not really that good at.
Yeah, no, I think it is important to be humble, and it's interesting to me though the like driving, the self-driving
Right.
capabilities. I'm eager in the sense that hey, it would be nice to tune out during a drive or just
Yeah.
repurpose that time to do other things. So I get that aspect of it, but I'm a little bit fearful in the sense of losing the autonomy, right? So it's not the I'm not I'm eager to have the capability to use automated driving. I'm not eager to have the future where automated driving is mandated and I don't have the ability to just jump in my car and go where I want to go with my hands
Oh
on
yeah,
the
it's the desire for freedom. But look, I think we'll still have driving as recreation. I would enjoy that. Like in Virginia, there's that the turnpike that takes you into the airport. Uh,
Dulles Toll Road.
there's like a more scenic route. It's a longer but more scenic. I always
Oh,
enjoy
sure.
that. Right. It's like an extra 10 minutes, but it's such a great drive. Like I'd enjoy that. There are parts in here in like Hudson Valley like that as
Oh,
well.
yeah.
But
I think you're talking about GW Parkway, maybe. That was
That's the
one.
one. GW Parkway. Right. Right. Like they're just
Yeah.
incredible drives, or like on Highway 1 California. Incredible
Yes.
drives. And being able to like handle a vehicle as well. And it's like driving as recreation.
Yes.
Totally can see that.
I
But
agree.
our insurance costs are going to drop for people that give up driving.
Isn't that the interesting paradox of this entire thing with automated driving? Given that, like, how many accidents occur on a daily basis because humans are behind the wheel, and how many people die every year tragically from car accidents that could or could perhaps not be prevented. But automated driving, it's like, look, anybody's death is tragic. However, a death from an automated driving vehicle gets portrayed as if it's, you know, it should be the death knell of automated driving, when in reality, it's going to be, they're a lot better drivers than humans, or will be once it's rolled out.
Right. It'll save lives.
It'll save lives.
But even though there will be headlines about death, unfortunately,
Yeah.
which is sad. But yeah, no, it's going to save lives, of course. People like me will not be driving anymore. And we should bring that future to the present as fast as we possibly can.
It is going to mess with insurance companies, though. I think that's an interesting one. You and I have talked about that a little bit, and it's
Yeah.
premature from an investment theme standpoint. However, in the future, if accident rates go tumble downward because of automated driving, insurance rates should as well, which means insurance companies should have fewer dollars to invest over
Yeah,
time.
look, it's going to lower costs for consumers. Great. Good news. More disposable
Yes.
income. So CoreWeave, I guess CoreWeave was in the news. Let's pull that up real quick here. Let me share that screen. I don't think people know CoreWeave. CoreWeave is one of the few IPOs I'm really looking forward to, actually. Most IPOs are VCs dumping on public markets. Okay. But this one is a special one. We're investors in CoreWeave, full disclosure. So, we invested in CoreWeave in October. I think it closed in November. And we got in at this 7 billion valuation private deal, but it's going to go public maybe end of this year, possibly the year after that. And the valuation is already up to $16 billion. The crazy thing about it is this. I remember at that time, OpenAI was doing their financing round, and the demand is quote unquote unlimited for that. I argue that CoreWeave is the better move. And so far we're seeing that. Where's the OpenAI 2.5x multiple on initial value? By the way, now OpenAI's got competition all over the place, from Anthropic. Inflection got, of course, bought by Microsoft, but Perplexity, Google Gemini, Hugging Face actually looks kind of decent now. Databricks rolled out a new LLM. It's getting cheaper to build these LLMs now. So, you're starting to embed ads in LLM. So Perplexity, I believe, is doing that now. So Google's got a business model again. Like, that was the FOMO deal. The FOMO trade was go invest in OpenAI. And because Sam Altman is there, and we saw that deal, we said no. Anthropic, we said no. By the way, we had the Tesla deal, the XAI deal. We said no to that. People are not aware of that deal yet. We should share that at a later time frame, but it's like multi-billion-dollar valuation for no product. Well, maybe some product. I don't know. No revenue for sure. It's like, why would you do that?
So to that point, I think I know why folks do that, or at least in the private wealth management space. I had an interesting conversation when I was in California on this exact topic with some people who are at the leading edge of some AI capabilities. And the consensus view that I distilled from the conversation was that investing in OpenAI at that time frame, because I talked a little bit about the CoreWeave deal and the timing and semiconductors and the infrastructure play. But at the time, the OpenAI deal was attractive for some investors, primarily because they got to go to their golf course or their country club or their flying club or their racing club and say, dude, I'm invested in OpenAI. And it wasn't about the economic return as much as it was the social credit. And I think when we were looking at these opportunities, we were saying like, look, this isn't a social club. This is about prudently investing dollars of clients in the most attractive opportunities from a risk-adjusted basis.
Well, risk-adjusted is exactly the right word, because I'm not saying OpenAI will not do a 2x or 3x. It could. I wouldn't bet against Sam Altman. He's an incredible operator, entrepreneur, and Microsoft is behind them. It's powerful. Now they have issues, though. We can get into issues some other time. The least of which is they're competing with their parent company for enterprise business, and they don't have focus on a customer segment. They're trying to straddle consumer and enterprise. How does that work? But the point is like risk-adjusted return. Like, what's the return you're going to generate per unit of risk while being mindful of potential downside? Like, it's hard to screw up CoreWeave when public comps like Prologis and EQIX trade at a higher multiple. So those are publicly traded data center facility space providers that CoreWeave would rent. So they pick and design these spaces next to big energy utility hubs. And then CoreWeave says, okay, we want that. We're going to lease it out. And Microsoft will try to bid on that space too. And so will Google and all the rest, right? There's a lot of demand for that space, of course. But the PE ratios on those are already, certainly at the time when we did the underwriting for CoreWeave, higher than CoreWeave. So there's downside risk, but you need to bet on multiple compression from these other guys. I got a margin of safety in a sense. And CoreWeave's doing a more value-added activity, and they're differentiated. So, that's the thing. And there's a path of liquidity that's coming in 2 years, so we can recycle capital into the next best opportunity versus waiting for 6 years, right? And you got an opportunity cost of capital around that time. Who knows what the world's going to look like after we go through the singularity, Stargate, wormhole, event horizon, right? I mean,
dark,
right? So, it's a human behavior. It's like this idea to be in the club. It's a bad behavior. It's a bad instinct to have. It's the bandwagon phenomena, which is another behavioral bias. I think it's called the bandwagon bias that Kahneman talks about. But if you're not willing to walk around with like mustard on your shirt, you shouldn't be an investor. You got to be willing to tolerate resistance or what's the word I'm looking for? Criticism or
gotta be willing to go against the grain.
Go against the grain.
That's interesting. I like that.
What else? So we got a few topics we covered here. Macro. All right, I'll be brief here. More to come this weekend's Lumina Ledger. So we got a kind of like a downdraft the last 2 days. So after the FOMC meeting, we saw this leadership rotation and a focus on new categories like energy. Mm-hmm. And guess which category performed best today? It's energy and utilities. This is funny. I was on the on Howard's podcast, Howard Linston, Trends with Friends. We're talking about energy, and energy is a diversifier for tech. See, it used to be that when tech stocks dropped, bonds would go up. You got diversification. So today, there's no diversification. Tech stocks drop and bonds drop. The whole point of bonds was to diversify your portfolio. Well, guess what? What went up was energy. Energy are the new bonds. And we saw that.
So unpack that a little bit more, because we talked a little bit earlier about energy rising with some of these infrastructure AI opportunities. How does it, in your mind, become a diversifier today from tech? Is that just you're seeing the evidence of it, or you have a theory as to why it's occurring?
Good question. So one is we see the empirical evidence of that. We've seen that evidence for like the better half of a full year now, by the way. And you can see it right here on the screen, right? You can see technology down, energy up. And the hallmark of science is if you can make a prediction and your prediction is not falsified. And that's what we've been doing. Literally last week, talking to Howard and JC and Phil, I'm like, guys, look, tech drops often is the case, energy will rise. And that's what's happening today. So for causal reasons, I would say a few things. It's a very profound question you're asking there. Well, one is, look, energy offers the most earnings yield, the most value out of all of the sectors within the stock market. If you look at the PE ratios or price to cash flow, it's the cheapest sector. One. So it's the exact opposite of technology in that sense, which is at the 95th percentile valuation. Okay. Two, the throwing off of dividends and cash flow. They've got clean balance sheets. So dividends are also, bonds throw off coupon. So they do have like this bond-like characteristic, but the difference is that energy companies compound and grow in value if they're well run and well managed, like a business. So that dividend increases over time, unlike a bond where, as you know, you've got that fixed contractual payment. It does not increase over time. In fact, inflation erodes that value over time. Mm-hmm. And if interest rates go higher, like they are today, then the value of that bond declines in value. And the best you get, your upside is fully capped the moment you buy a bond. That's it. That's the way to think about it. Unlike when you buy a business. So energy, in that sense, are the new bonds because they are throwing off cash flow. They are throwing off dividends. Their dividends like in the teens. Kind of amazing. And free cash flow yield, that's in the high single digits to the teens. So, or they're buying back shares, which I prefer over the dividend. But, energy's third factor is that they're unloved and underowned, right? So energy as a share of the S&P 500 is 3%. The tech Mag 7 share, which everyone's been talking about, is like 33% at a peak. So there's that mean reversion component. So those three kind of dimensions are at odds with one another. Both will go up over time, right? They'll both go up over time because they're both growing earnings. But during that journey, energy is a great diversifier for tech. And that's what you want. You want growth. You want diversification so you sleep better at night. So we've been buying energy. We've been buying home builders too, which is great over the last few weeks. It's the time to buy semis and tech was like October of last year. And there are moves in those categories too, but you have to be very precise. Like I wouldn't buy like Microsoft. I wouldn't buy Amazon. We haven't. We said we haven't. Google. We bought a boatload of Google like last month, right?
Let's talk a little bit about that because I think it's an important component of how we operate as a business. I know a conversation that I and you both have with clients and prospective clients, which is we're not a hedge fund, right? So you're not, as a client, buying into a net asset value that exists today because of moves that we made 6 months ago. That said, maybe what you own today is very different than a client who came on board 6 months ago as a result. But that's an important
it's a
component
crucial
of the way we work.
No one talks about this in wealth management. So I'll explain why. If you own an ETF, a mutual fund, or investment in a hedge fund, you're going to have performance lag. It's structurally built in. And this is double click on exactly what you're saying. So we have separately managed accounts for everyone's got a distinct account, right? And they're all custodied at Schwab. We never want to custody anything. Okay. So someone came on board March, April of last year. We were buying banks. Why? Because banks were on sale. There's dislocation about the best banks in the land, things like JPM, UBS. JPM's up 50% plus in a year, by the way, just crossing long-term capital gains. Would I buy JP Morgan now? No. Would I buy it 3 months ago? No. Would I buy 6 months ago? No. The time to buy it was in March or April of last year. That's what we always say, quote, you make your money on the buy. Right? You get a good entry with a good valuation when things are on sale. When Mr. Market spits out a stupid price on a value that on an asset's got higher intrinsic value, you're supposed to buy that. JP Morgan's the best in the land, even though I would never bank there. Right? That's why it's the best in the land for shareholders. They pay 0% to depositors. I mean, I'd rather be on their side of the table than the customer side of the table. Right? That's a simple
house always wins.
The house wins with JP Morgan, right? That's why we need competition for them. So, but the point is this though, like if you're investing in March, April, you should have been buying JP Morgan and UBS. But that doesn't mean you buy it now, even though some of our clients actually own it. And, clients that got on board in October, they've got a boatload of semiconductors because that was the best thing to buy then. And the best thing to buy now are energy and home builders. Now, because you're getting good entry and good valuations on those themes at the right prices. Okay. Now, do these ever synchronize is a really interesting question. The answer is yes, they do synchronize, and they synchronize at the bottom of a correction, because at the bottom of a correction, everything's on sale. So you rotate to the asset that has the highest risk-adjusted return. That's the key idea. So when you buy an ETF, let's say you go online, you say, oh, let's find the best 5-star Morningstar rated ETF. You're buying it into an ETF that's already appreciated in value. Or you bought into a hedge fund that's already appreciated in value the last 12 months. You're buying old positions. You're buying the JP Morgan today that you should have bought 12 months ago. Same thing with the mutual fund. And most
not the gain though. To be clear though, you're not buying the gain. Right.
Say some more about that. Exactly.
Well, I guess the point being, like, let's be clear, you're not buying the increased appreciation that the fund or the ETF has realized during the period of time between when they acquired the position and when you enter into that fund or ETF. You're buying at a present day snapshot value.
You're not getting the value that they bought. Like when Bill Ackman bought Chipotle Mexican Grill, he's up 6% for the year, by the way, which is underwhelming, I would say. But he bought Chipotle Mexican Grill when it was on sale. They're dislocated. Remember, they had this issue where there was like a food poisoning.
Yeah, they had some E. coli, I think.
Right, exactly. Like the stock dumped. That was the time to buy because it's a quality franchise with an issue that can be addressed, and they did. Right. And they're not going to sell that anytime soon. So that was a time to go invest in Pershing Square, although you should have just bought Chipotle Mexican Grill if you had that foresight. But maybe you don't have the time, so you'd find a manager, right? But the problem now is you're buying in at it's already at the peak value, that you're not buying into the value creation nor participating in that. It already took place. It's behind you.
Exactly.
So this is the thing. So the 99.99% of wealth, and look at it like Goldman's conviction buy list. They have this top 10 stocks. So those aren't all the best ideas every single day. By definition, they cannot be. Only sometimes. Certainly not Apple. Forget that one, obviously. But the optimal portfolio one should buy actually varies in general every day. I mean, like weekly to monthly or quarterly, if you want to zoom out a little bit, if you want to be less tactical, right? So that's the key takeaway. So vast majority of wealth managers, what they do, they have a model portfolio. We know this because of the software that we've interacted with, like Orion, all this stuff. They all say, put in your model portfolio because everyone gets the same cookie cutter portfolio. Yeah. And so they say, oh, these are the stocks we like.
Right. But and then we'll rebalance that portfolio across everybody's account. You're like, well, that doesn't work for us.
And it makes it easy for the wealth manager because every client's got the same positions. But it doesn't drive performance. It actually hurts client performance. Yeah. It's a very abstract idea to get your head around, but it really is an important driver of performance and return. So What we have to do is we actually have to manage our high conviction list across themes. And we always know we have a view on these are the best businesses in the world and assets in the world at any given time, but they aren't always the best asset to buy today because they're not priced correctly. When they're priced correctly, we go buy. We bought uranium a month ago. Goldman upgraded Cameco yesterday, up 7%. Of course, we were buying Cameco last summer too, but tactically, we rotate into uranium about a month ago. I mean, we're adding to uranium about a month ago. It was on sale,
Exactly.
then, right? So, yeah, that's a really subtle point that people, and there's no technology or systems built to make this easy for the RIAs. So that world will persist. We actually have to invest our own tech and infra. So we have like 8, 9 people going on to 10 here. People think it's just you and me. It's not. There's like a lot of infra technology. You and I both built engineering teams, et cetera, right? But like that's
it's like sitting at that intersection of like a hedge fund and an SMA, right? It's like, because there's tools for hedge funds for sure. Of course, those exist. And there's tools for, wealth managers that want to take that cookie cutter model portfolio approach.
Right.
But the intersection of those where you can drive performance for a client, you can, really frankly discharge your fiduciary duty as an RIA to your client, each client, not all of your clients, to some collective notion of fiduciary duty.
That's right. It's a great point. Exactly. The only 2 clients that have identical portfolios are if they fund their account in the exact same day. Then by definition, their portfolios should evolve identically. But if they're off by even 2 weeks or even a few days, they're not. Because we're looking to buy things that we expect where that theme will perform. It's on sale. We got a good inflection point.
And then even just a deeper cut on that, when you say their portfolios will be the same because they bought the same day, that's only their public portfolio.
Correct.
That's the same. Correct. That doesn't mean that like the third-party managers or digital asset or the totality of their
Thank you for correcting me. You're absolutely right. So that's exactly right. Because people have different risk tolerances. And so, liquidity needs and time horizon. So there's a broader asset allocation outside the public equities where you calibrate that. Like public, CoreWeave is a good example. That's a private deal. The funny thing about this is that the alternative investments, I believe, will outperform the public equities, even though we're doing great in public equities, like, teens-like returns right now, okay, year to date. So
past performance is not a predictor of future success.
Correct. Compliance officer, yeah. So, but the point is, like CoreWeave, like 2.5x in like 6 months, 5 months, right? I mean, but people aren't either sometimes comfortable or skillful in sourcing or knowing what to look for. Not people knew what CoreWeave was in October. That was the biggest issue. So we had to like educate our client, like, what is this? Yeah. But that's also the opportunity. Now you're seeing a Bloomberg article come out yesterday, and there was an Odd Lots podcast last summer. There was another podcast interview. So you're seeing that focus increase, right? But that's the other part. Like alternatives actually do work. They really do work, but you have to have the skill to source, assess, and diligence. You have to do background checks. You got to validate they have title to the assets. You got to validate you got a third-party fund admin to reconcile all the values. I mean, there's a lot there. You can't just like, you can't be the VC. I heard a story about a VC guy that just bought into commercial real estate, like on a call. I was like, what are you doing? How do you know that they own the buildings they say they own? How do you know that the returns they put in that PowerPoint slide are real, or how they calculated those returns?
Yeah.
Who's marking these illiquid assets? There's a lot there. It's not.
There is a lot there. I mean, it's funny that you say that. Not to disparage any particular set of folks, but I thought it was interesting when the VC diligence of FTX came to light. And, you said, here's a set of people who take a lot of bets and their underlying diligence may be lacking in some regards. That's not to say all or paint with a broad brush, but some people, regardless of industry, don't really dig as deep as they need to dig to make a decision, whatever that decision may be.
Venture, you're underwriting a team, traction, and an idea, right? With real assets and real business is very different. You're doing private equity firms will retain like the McKinseys of the world to go
Right.
diligence, or they'll hire an auditor to go validate that oil is in the oil well. And they'll open up the top, they'll put in a tube, and they'll look at that, and they'll do a sample. Remember, so we'll have to have Peter and Jeff, our diligence team, join us. But remember this client in Puerto Rico, they sourced the deal themselves, came to us. We did background checks. We found one party was it
Yellow flags. We'll just say the
yellow flags, high level. Why don't you introduce it so I don't step over on the boundary?
I would just say, so we had a client who found a potential investment that was tax advantaged, and they were eager to invest, but it was important that we kind of play the, bad cop in a way. Like, let's put the brakes on this opportunity and not get pressured into a time-sensitive close, and do the appropriate diligence to make sure there's a there. And ultimately, we did give a green light to the investment, but it took time, and there were definitely a fair number of yellow flags that could, had they not been dispositioned properly, led to an absolute no. Other diligence for investments have led to an absolute no. In this example, there were some alarm bells that went off. It turned out they were able to be explained.
This was someone who had an infraction with cannabis 15 years ago, thought it was expunged on their record, and then when faced with that, said, one, how did you guys figure this out? And because it was under seal, that infraction. And they broke down in tears, and they were like, and there was it was a conversation, and then a lot of like, what's going on here, and trying to understand the parameters around this and what happened, and validate the assertion. There's a lot that happens in diligence that.
Yeah, exactly. Well, I mean, you see what happens this is like the most archetype example, but like Bernie Madoff, right? Like somebody somewhere could have dug and said, well, like, what is underlying these numbers? And I'm sure many people did and passed, but many people just took it on faith.
Correct.
And,
Correct.
Those things crash and burn. Your little entry in is happening in my house now. My kids are coming back home.
We can call it a wrap. We covered a lot of ground. That was fun. I'll be brief there. On the Madoff, I would say this. There are good regs post that require separation of duties. So a hedge fund can no longer be their own custodian, which is very good. It's very good law, very good regulation. You cannot mark your own, you can't be your own fund admin. But there's still these gray areas, especially in private credit, because there's so much discretion and latitude around how you value your assets. And
that's coming up right now in public news for private credit.
That's right. That's right.
Something we should talk about next week.
That's right. Let's call it a wrap.
All right.
Later, Judson. Take care. Be well. Everyone. Bye. Watch the 10-year, by the way, for folks looking at the macro. Okay.
That's true.
All right. There we go. Take care. Bye-bye.